There's a lie sitting in your brokerage account right now. It is a lie that sustains the entire global financial system. It is a lie that keeps the price of real things artificially low, while the price of financial fantasies goes to the moon. You are wrong. That number is not the price of metal. That number is the price of a bet. It is the price of a paper promise issued by a system that has sold the same ounce of silver to 500 different people. We are not talking about a market anymore. We are talking about a fractional reserve Ponzi scheme that is mathematically guaranteed to collapse the moment the participants ask for their property back. To understand why the Comex, the commodity exchange, is destined to fail, you have to understand what it was designed to do versus what it has become. Originally, futures markets were created for farmers and miners. A wheat farmer wants to sell his crop before he harvests it to lock in a price. A bread manufacturer wants to buy that crop to lock in his costs. They use a contract to hedge their risk. At the end of the contract, the farmer delivers the wheat and the baker pays the money. It was a mechanism for physical delivery. That is not what the market is today. Today, the Comex is a casino. It is dominated by speculators, hedge funds, and bullion banks who have absolutely no intention of ever touching a bar of silver. They are trading paper silver. They are trading electronic receipts. Here's the terrifying statistic that Wall Street doesn't want you to think about. The open interest. Open interest is the total number of outstanding futures contracts. If you take the total number of ounces represented by all the paper contracts open on the Comex and compare it to the actual physical deliverable silver sitting in the registered vaults, the ratio is staggering. At times we have seen this ratio hit 300 to 1, 400 to 1, or even 500 to 1. This means that for every single ounce of physical silver that actually exists in the warehouse available for delivery, there are 500 people holding a piece of paper that says, "I own silver." Think about that for a second. Imagine a car dealership. They have one car on the lot. A beautiful red Ferrari. You walk in, pay them $300,000, and they give you a title deed. But you don't take the car home yet. You leave it in their garage. Then, 10 minutes later, another man walks in. He pays $300,000. They give him a title deed for the exact same car. Then a third man walks in, a fourth, a 500th. The dealership has collected $150 million for a single $300,000 car. Everyone walks around town showing off their title deed. Everyone feels rich. The market for Ferraris looks liquid and active. But the system only works as long as nobody comes to pick up the car. What happens when 2 people show up on the same day with their keys? What happens when 10 people show up? The dealership locks the doors. The managers flee. And 499 people realize that their piece of paper is worthless. This is exactly how the silver market is structured. It is a game of musical chairs where there is 1 chair and 500 players. And the music is about to stop. The banks argue that this is fine. They say, most people trade on margin. Most people just want cash settlement. They don't want the metal. And historically, they have been right. Most traders are speculators. They just want to bet on the price direction. When the contract expires, they either roll it over to the next month or they settle for the cash difference. No metal moves. The illusion remains intact. But this relies on confidence. It relies on the belief that if you wanted the metal, you could get it. It relies on the market participants being purely financial players. But what happens when the players change? What happens when the people buying the contracts aren't hedge funds, but industrial giants who need silver for solar panels? What happens when sovereign nations start buying contracts because they want to exit the US dollar? These buyers don't want cash. You cannot build a missile with a cash settlement check. You cannot build a solar panel with a wire transfer. You need the physical element. When these entities stand for delivery, they drain the physical inventory from the vault. And here is where the leverage kills the system. Because the ratio is 500 to 1, you only need a tiny fraction of the paper holders to demand delivery to wipe out the entire stock. If just 1% of the paper holders decided to convert their contracts to physical metal, there would be 0 silver left in the Comex vaults. 0. The remaining 99% would be left holding an empty bag. This is why the price you see on your screen is a lie. That price is the price of the paper claim, assuming it is never exercised. It is not the price of the scarce asset. The system is kept alive by the bullion banks. The massive institutions like JP Morgan, HSBC, and others who act as the market makers, they manage this paper Ponzi. They use high-frequency trading algorithms to spoof the price, to slam the market with massive sell orders, naked shorts, whenever the price gets too high. Why do they suppress the price? Because they are short. They have sold those 500 paper claims. If the price goes up, they lose billions. If the price skyrockets, they go bankrupt. They have a vested interest in ensuring that you, the investor, never look behind the curtain. They need you to believe that paper gold is as good as physical gold. But the cracks are starting to show. We are seeing backwardation in the markets. Backwardation is a freak event in commodities. Normally, a future contract should cost more than the spot price because you have to pay for storage and insurance. When the spot price is higher than the futures price, it screams shortage. It means people are willing to pay a premium to get the metal right now rather than wait a month. We are seeing backwardation appear more frequently. It is the market screaming that physical metal is tight, even while the paper price is smashed down. It is the sound of the dealership running out of keys. The system creates a false sense of abundance. By selling 500 paper ounces for every real ounce, the banks artificially inflate the supply. They make it look like there is 500 times more silver in the world than there actually is. This basic supply and demand economics dictates that if supply is artificially high, the price is artificially low. This effectively subsidizes the consumption of silver. Because the price is suppressed by paper trading, electronics manufacturers and solar companies can buy silver cheaply. They consume it, burn it up, and throw it away. If the price reflected the true scarcity, we would be recycling everything. Instead, we are wasting a critical strategic asset because a paper market says it is cheap. We are living through the final days of this mechanism. The divergence between the paper price and the physical reality is stretching to the breaking point. You cannot suppress the price of a physical commodity forever. Eventually, the warehouse is empty. Eventually, the fraud is exposed. And when the Comex collapses, it won't be a gradual decline. It will be a sudden, violent cessation of trading. Now that we understand the broad concept of the paper illusion, we need to pop the hood and look at the engine of this fraud. We need to talk about rehypothecation. This is a fancy banking term designed to bore you so you don't ask questions. But it is actually the mechanism of theft. Rehypothecation, in simple terms, is the practice of using client assets as collateral for the bank's own trades. In the context of the precious metals market, it means the bank takes the gold or silver that is supposed to be sitting in your account and lends it out to someone else. Let's say you are a wealthy individual or a fund, and you buy 1,000 ounces of gold. You pay the bank to store it. The bank says, sure, we will keep it safe. But unless you have a specifically allocated and segregated account, which costs a lot more, the bank considers that gold to be part of its general liquidity pool. They take your gold and lease it to a short seller. The short seller sells it into the market to suppress the price. The person who buys it thinks they own gold. You think you own gold. But there's only one pile of gold and it has moved. The bank has effectively created two claims on one asset. They have printed paper gold out of thin air. This happens over and over again. Bank A lends to Bank B, who lends to a hedge fund, who sells to an ETF. This daisy chain of ownership means that nobody actually knows who owns the physical bar at the end of the line. This is how they inflate the supply. This is how they keep the game going. To hide this, the Comex uses a very specific set of definitions for the inventory in their vaults. You will often see reports about Comex inventory levels. You need to understand the difference between eligible and registered. These two words are the key to the shell game. Now, eligible silver is metal that is sitting in a Comex-approved vault, meeting the purity standards, but it is not available for delivery against a futures contract. It belongs to someone, a private investor, a family office, a bank, who is just storing it there. It is not part of the market supply. It is private property. The registered silver is metal that has a warrant attached to it. It is available for delivery. It is the actual inventory that backs the thousands of paper contracts we talked about. This is the only number that matters for the pricing mechanism. Here's the trick. The banks will often tout the total inventory numbers, combining eligible and registered, to make it look like there's plenty of silver. They point to the eligible pile and say, look, hundreds of millions of ounces. But that metal is not for sale. It is spoken for. When the registered stocks get dangerously low, which is happening right now, the banks play a shell game. They will convince a holder of eligible metal to momentarily reclassify it as registered. Or the bank itself will move metal from its private stash into the registered category. Why do they do this? To paint the tape, to create the visual appearance of solvency. If registered stocks drop to zero, the market breaks. So they move metal in, print the report showing inventory is stable, and then quietly move it back out later. It is accounting gymnastics. It is shifting money from your savings account to your checking account to show the loan officer you have cash, then moving it back before the check bounces. But the most damning evidence of the shortage is the lease rate. In a normal world, if you have gold or silver, you have to pay someone to store it. Storage costs money, security costs money, so the interest rate on holding gold should be negative. You pay to hold it. But in the wholesale market, there is a silver lease rate. This is the interest rate banks pay to borrow physical silver. When physical silver is plentiful, the lease rate is tiny or negative. But when physical silver is scarce, the lease rate spikes. Why would a bank pay you interest to borrow a bar of silver? Because they are desperate. They have a delivery obligation they cannot meet. They need the physical metal immediately to settle a trade or satisfy a client who is demanding delivery. So they go into the market and offer to pay high interest just to rent the metal for a month. We have seen lease rates spiking repeatedly in recent years. This is the heartbeat of a dying patient. It tells us that behind the curtain, the banks are scrambling. They are borrowing from Peter to pay Paul. They are rehypothecating the same bars over and over to keep the velocity of metal moving fast enough to hide the lack of volume. And let's talk about the ETFs, exchange-traded funds like SLV. Millions of retail investors buy SLV thinking they are investing in silver. But read the prospectus. It is a nightmare of legal loopholes. The prospectus of many silver ETFs states that the custodian, often JP Morgan, is allowed to use sub-custodians. It states that they can hold unallocated metal. It states that in the event of a shortage, they can settle in cash. When you buy shares of an ETF, you are not taking silver off the market. You are buying a share in a trust that claims to hold silver, but the mechanism by which they acquire that silver is opaque. Often, the authorized participant, the bank, deposits a basket of assets to create shares. That basket is supposed to be metal, but given the rehypothecation we just discussed, is it unencumbered metal, or is it metal that has already been leased? Many analysts believe the ETFs are actually the source of the physical metal used to suppress the price. When the price rises, the banks might short the futures market. Where do they get the metal to back those shorts? They might borrow it from the ETF inventory. It is a closed loop. The money you put into the ETF to bet on the price going up might be used to secure the metal that is dumped on the market to force the price down. It is perverse. It is a system designed to strip wealth from the retail investor and transfer it to the bullion banks. This entire structure, rehypothecation, the eligible Troy-registered shuffle, the ETF loopholes, creates a paper silver market that is 100 times larger than the physical market. It allows the tail to wag the dog. The paper price drives the physical price, which is economically backward. In a free market, the physical supply and demand should set the price. If demand for solar panels goes up, the price should go up. But in the Comex system, if demand goes up, the banks can just print more paper contracts to absorb that demand without the price rising. They dilute the market. Imagine if you had a rare Charizard Pokemon card. There are only 10 in the world. The price is high. Now imagine someone sets up a Xerox machine and starts selling paper Charizards for $1 each, claiming they are just as good. The price of your real card would crash because the market is flooded with cheap substitutes. That is what the Comex is. It is a Xerox machine for precious metals. It suppresses the value of real money by printing infinite paper substitutes. But unlike a Xerox copy, which everyone knows is fake, the financial world has agreed to pretend the paper contract is real. Until it isn't. Until the day the Xerox machine breaks. Until the day the guy with the real Charizard refuses to sell it for the price of the Xerox copy. That is the day the rehypothecation chain snaps. That is the day the multiple claims on a single ounce collide. We have built the scene. We have a casino selling 500 tickets for every one prize. We have a vault system that shuffles inventory to hide the emptiness. We have a rehypothecation chain that links everyone together in a web of debt. Now, let's talk about how it breaks. Let's talk about the run on the bank. A run on the bank is a psychological event. It happens when fear overcomes greed. It happens when the return of your money becomes more important than the return on your money. In the banking world, this is when everyone lines up at the ATM. In the metals world, this is when everyone stands for delivery. Standing for delivery is the term for holding a futures contract until it expires and demanding the physical warrant. As we discussed, usually less than 1% of traders do this. But what happens if that number goes to 2% or 5%? The system is not designed for 5% delivery. It physically cannot handle it. There aren't enough trucks. There aren't enough bars. There isn't enough insurance capacity. And most importantly, there isn't enough metal in the registered category. If 5% of the open interest demanded delivery, the Comex would declare force majeure. This is a legal clause that basically says, due to unforeseen circumstances, we cannot fulfill our contract. So what happens? Do they give you the metal later? No, they force you to settle in cash. They will look at the last traded price, let's say 30, and they will wire $30 to your account. They will cancel your contract. You might think, well, at least I got my money back. No, you didn't. Because in this scenario, the reason the exchange broke is that the real price of silver has detached from the paper price. While the Comex is claiming the price is $30 and forcing you to take a $30 check, the street price for actual physical silver might be $100, $200, or priceless. You cannot take that $30 check and buy an ounce of silver anymore. You have been cashed out at an artificial low while the real asset goes to the moon. You have been robbed. This is not a theoretical scenario. We saw a preview of this with the London Metal Exchange LME nickel squeeze in March 2022. This is the most important financial event that nobody talks about. A Chinese tycoon nicknamed Big Shot had a massive short position in nickel. The price of nickel started to rise violently due to the Russia-Ukraine war. He was facing a margin call in the billions. The price doubled in a matter of hours. By the rules of the free market, he should have gone bankrupt. The banks that lent to him should have taken massive losses. But that didn't happen. The LME, the exchange itself, halted trading. They didn't just stop trading, they canceled the trades. They looked at the billions of dollars of legitimate profits made by people who were long nickel, and they deleted them. They rewound the clock. They said, those trades never happened. They did this to save the bullion banks and the Chinese tycoon. This proved beyond a shadow of a doubt that the exchanges are not neutral platforms. They're owned and operated by the banks, for the banks. If the banks are losing money, the casino closes. If they did this for nickel, which is an industrial metal, what do you think they will do for silver and gold, which are the enemies of the fiat currency system? They will change the rules in a heartbeat. They will raise margin requirements to 100% to force you to sell. They will institute liquidation-only trading where you can sell but not buy. And if all else fails, they will simply settle your contracts in cash and tell you to go home. So, what triggers the run on silver? It won't be retail investors. It will be the industrial users and sovereign nations. We are already seeing the BRICS nations, Brazil, Russia, India, China, South Africa, moving to settle trade in commodities rather than dollars. They are accumulating physical gold at a record pace. Silver will follow. Imagine a scenario where Tesla realizes that silver supply is critical for their cars and robots. Elon Musk looks at the Comex price of $30 and the physical shortage and says, this is cheap. He directs Tesla to buy 100 million ounces of physical silver for delivery. That order alone would break the Comex. The bullion banks would panic. They would scramble to find the metal. They would try to lease it. They would try to persuade Tesla to take a cash deal. If Tesla refused and demanded the metal, the default would be public. Once a default happens, once the world sees that the Comex cannot deliver, confidence evaporates instantly. Every other holder of a paper contract will rush for the exit. But the exit isn't selling. The exit is demanding metal. Everyone will want to grab a chair before the music stops. This creates a feedback loop. As inventory drops, the premium for physical metal rises. As the premium rises, more arbitrage traders try to buy paper and take delivery to sell at the higher physical price. This drains the inventory faster. It is a death spiral for the paper exchange. We are also seeing a shift in psychology. For 40 years, investors were happy with financialized assets, stocks, bonds, ETFs. But with inflation returning, with bank failures like Silicon Valley Bank, people are remembering counterparty risk. Counterparty risk is the risk that the guy on the other side of the bet can't pay up. When you hold physical silver in your hand, there is no counterparty risk. It is a bearer asset. When you hold a Comex contract, your counterparty is a leveraged bank or a clearinghouse. In a systemic crisis, counterparties die. We learned this in 2008. Lehman Brothers died. Bear Stearns died. In the next crisis, the entities shorting silver could die. The run on the bank for silver will be quiet at first. It starts with the smart money silently removing their allocated bars from the banking system and putting them in private vaults. This is already happening. Family offices are moving out of London and New York vaults and into Singapore and Switzerland into non-bank vaults. Then the premiums on coins start to widen. We saw Silver Eagles trading at 40% premiums recently. That is the market signaling stress. Finally, the industrial panic sets in. When Apple can't get silver for iPhones or Samsung can't get it for chips, they will bypass the futures market entirely. They will go directly to the miners and buy the production at the mine gate. This essentially delists silver from the public market. If the miners sell all their metal directly to Tesla and Apple, there's nothing left for the Comex. The Comex becomes a ghost market, trading paper contracts on a commodity that never arrives. At that point, the price on the screen is meaningless. It becomes like the official exchange rate of a failed currency. The government might say 1 peso equals $1, but on the street, it costs 100 pesos to buy a dollar. The Comex might say silver is $35, but try to buy an ounce for less than $100. You won't be able to. So, what does the world look like after the collapse? What happens when the 500 claims collide with a single ounce? We enter a period of price discovery. This sounds technical, but it is actually violent. Price discovery is what happens when a manipulated market is finally set free. It is the release of a beach ball that has been held underwater for decades. In the immediate aftermath of a Comex failure, trading would likely be suspended. The news headlines would scream about irregularities in the metals market. The exchanges would claim they are protecting investors by freezing accounts. During this freeze, the black market becomes the real market. The price of silver will be discovered at local coin shops, online bullion dealers, and in private transactions. And that price will shock the world. Without the naked shorting of the bullion banks, without the dilution of paper contracts, silver will seek its equilibrium. Given the inflation of the money supply since 1980, and given the industrial indispensability of the metal, triple-digit silver is not just possible, it is mathematically probable. We are talking about a wealth transfer. This is the crucial part. Wealth is never destroyed, it is merely transferred. In a Comex collapse, Wealth is transferred from those who hold paper promises to those who hold physical reality. The millions of investors holding unallocated, pooled accounts, ETFs, and futures contracts will effectively be wiped out or settled for pennies on the dollar in real purchasing power terms. Meanwhile, the weirdos, the stackers, the preppers, who have been ridiculed for hoarding monster boxes of coins in their basements, they will be the ones holding the only solvent currency. This decoupling will mark the end of the financial era and the return to the hard asset era. For the last 40 years, falling interest rates and financial engineering made paper assets king. You didn't need real things, you needed derivatives. But as we enter a world of resource scarcity, war, and deglobalization, paper promises lose their value. Trust is gone. If you're holding a contract that says a bank in London owes you silver, you are trusting that bank, the British legal system, the shipping lanes, and the solvency of the insurance company. If you hold the silver, you trust physics. Physics doesn't default. This is why the paper Ponzi matters to you, even if you aren't a day trader, because it represents the fragility of your entire portfolio. If the silver market is rigged, what about the bond market? What about the stock market? They are all interconnected. A collapse in the silver shorts could take down a major bullion bank. These banks are too big to fail. If one goes down, the Fed has to print trillions to bail them out. That printing causes inflation. That inflation makes silver go even higher. It is a self-reinforcing cycle. So what is the actionable advice here? It is a cliche in the metals community, but it is the only truth that matters. If you don't hold it, you don't own it. This means taking possession. If you have an unallocated account, allocate it. Better yet, take delivery. If you own an ETF, sell it and buy physical bars. If you trade futures, understand that you are playing in a casino that is rigged against you and cash out before the house locks the doors. There's a window of opportunity right now. The paper Ponzi is still spinning. The illusion is still holding. You can still trade your fiat currency, which is just another form of paper promise, for physical silver at prices that are historically suppressed. You can use the manipulation to your advantage. We are approaching a singularity in the financial markets. The mathematics of 500 claims on 1 ounce cannot be resolved peacefully. It can only be resolved through default. When the dust settles, there will be 2 types of people: those who have silver and those who have receipts for silver. The people with the receipts will spend years in court litigation, suing bankrupt shell companies. The people with the silver will be the new captains of capital. The Comex is a relic of a bygone era. It is a dinosaur waiting for the meteor. The meteor is the physical shortage. The meteor is the bricks. The meteor is the awakening of the public. Don't be the person standing in line at the dealership holding a piece of paper when the lights go out. Get your metal. Secure your wealth. And watch the paper castle burn from a safe distance. The Ponzi scheme is running out of new money. It is running out of physical metal. And time is running out for you to position yourself. The collapse of the paper market is not a question of if, but when. And looking at the drain on the vaults, when might be sooner than anyone thinks.